Are you tired of using trading indicators that don't work? Do you want to learn how to trade with one of the most powerful and versatile tools available? In this video, you'll discover everything you need to know about Bollinger Bands, what they are, how they work, how you can use it, its best settings, how accurate the indicator is, the best trading rules, and all backed by backtests. We also include how to avoid the biggest mistake traders make, and 3 practical trading techniques that can help you identify explosive moves, time your entries, and ride trends in the market. Welcome to Quantified Strategies. In this video, we are going to show you how to use the Bollinger Bands, one of the most popular trading indicators and used by traders all around the world. Bollinger Bands are used to identify trends, measure volatility, and find potential breakouts in the market. The bands can also be used for mean reversion strategies. As you will learn, there are many ways you can use the indicator. We will dive into a few practical trading techniques that we hope can help you improve your results and take your trading to a higher level. We also present you a very profitable Bollinger Band mean reversion strategy for S&P 500 at the end of the video. To understand Bollinger Bands, you need to know that they have 3 components. The middle band, which is a simple end-day moving average, for example, 10 days. On both sides of the moving average, there are 2 bands, the upper and lower bands, which are X standard deviations away from the mean, normally 2 standard deviations. Standard deviation is a statistical measure of how much the price deviates from the average, and it helps to measure volatility. When the bands are widening, it means volatility is picking up, and it's shrinking when the bands get tighter. The bands can also be used to find overbought and oversold conditions, but it doesn't necessarily mean that the market will reverse immediately. One of the typical mistakes traders make is blindly shorting or going long just because the price is at the outer band without considering the trend. Let's look at a backtest to illustrate our point and test the following strategy. When the share price closes 2 standard deviations below the 10-day average, we go long. We exit when it crosses above the 10-day average. Applied to S&P 500, the equity curve looks like this, and this is not a very inspiring curve. The sharp drops in value make this strategy untradeable, in our opinion. Let's look at another way to use Bollinger Bands, the squeeze. Let's talk about a Bollinger Band squeeze. One other way to use Bollinger Bands is by paying attention to the Bollinger Band squeeze, which occurs when the bands get tighter and tighter, indicating that the market's volatility is shrinking. In the blue rectangle, we can clearly see that the bands shrink because volatility drops. What does this mean? This might indicate an explosive move is about to happen. At least that is the theory. We backtested many variations of a Bollinger Band squeeze, and we didn't find it much useful, no matter the asset we looked on. The equity curve shows the best asset, and that was on Pepsi-Cola, which managed an annual return of 12.5%, slightly below buy and hold. However, this was among the best we could find. How about timing your entries? Another way to use Bollinger Bands is by timing your entries better. When the market is trending, John Bollinger, its inventor, argued the bands tend to retest the moving average in the middle before continuing in the direction of the trend, as indicated on the chart. We have not backtested this method of using the Bollinger Bands, though, because of the slightly complex rules needed to be used. Next part in this video is about riding trends. One other way to use Bollinger Bands frequently mentioned on blogs and social media is by riding trends in the market. For example, you can buy a breakout from the upper band and stay in the trade until it breaks below the lower band. This way, you can increase your chances of making significant profits. But does it work? Let's backtest it to find out. We use the trading rules on the screen, and we backtest S&P 500 from 1960 until today. We get the following result. It's only 81 trades since 1960, and you get 4% annual returns by being invested 56% of the time. The bonus is that you have the drawdowns compared to buy and hold to only 26%. Our final backtest of the day is slightly different, but we include it to show you a very good Bollinger Band strategy that is based on mean reversion. We use a 5-day moving average and reduce the bands to 1.5 standard deviations. We buy on weakness when S&P 500 closes below the lower band, and we sell on a day with strength when the close ends higher than yesterday's high. Hence, this is a Bollinger Band mean reversion strategy. Since 1993, this strategy has performed well, as the equity curve indicates. The annual return is 9%, which is just 0.5% lower than buy and hold, despite being invested only 25% of the time. There are 500 trades since 1993, and the average gain per trade is 0.5% for being invested 5 trading days per trade. The win rate is 76%, and thus the strategy is pretty accurate. Advantages and disadvantages of using Bollinger Bands. As with any trading indicator, the Bollinger Bands have its pros and cons. Also, what are some common mistakes that traders make when using Bollinger Bands? The biggest advantage is that the bands are easy to understand and interpret, and gives a clear understanding of the volatility. It might also indicate future trend directions. And as you saw in our last backtest, we used Bollinger Bands to create a very good strategy. However, if you are making trading rules based on the upper and lower bands, you might get large drawdowns. As with any indicator, one size doesn't fit all. Every asset is different, and you might need to use Bollinger differently on, for example, commodities compared to stocks. We believe the biggest mistake is that traders are looking for trading rules that fit all asset classes. But you can't expect this to work because assets move and behave differently. Are there different types of Bollinger Bands? And how do they differ from each other? Here are some examples of alternative bands: percentage Bollinger Bands, Bollinger Bandwidth, and double Bollinger Bands. We will not go into details about these in this video. We also frequently get asked about how traders can use Bollinger Bands in conjunction with other technical indicators. The answer is yes, that might be a good idea. But as always, we recommend backtesting your idea to find out if your idea works or not. So, there you have it. 3 practical trading techniques to help you master Bollinger Bands and improve your results. Remember, don't blindly short or go long just because the price is at the outer band without considering the trend. You should always backtest your ideas. Please stay tuned for our next video that includes our favorite trading indicator coming up right after this video, the IBS indicator. If you want to learn more about our trading approach, methodology, and strategy, please head over to our website and look at the hundreds of free trading strategies we offer. In conclusion, Bollinger Bands can be a powerful tool to help you identify trends, volatility, mean reversion, and potential breakouts in the market. However, the good is frequently in the absence of the bad, so make sure you backtest. Thank you for watching, and if you have any questions or feedback, please leave them in the comment section below. Don't forget to hit the like button and subscribe to our channel to stay up to date on future videos.